Good day, everyone, and welcome to this RMA Risk Readiness Briefing Special Coverage Series. My name is Stephen Martin, and I lead the business solutions at the RMA. We are proud to make this presentation today complimentary to our members, and if you're not a member, we urge you to explore all that the RMA has to offer at rmahq.org. Before we begin, I'd like to remind everyone that the RMA Annual Risk Management Virtual Conference is just 2 weeks away. It starts on November 9th, going through the 13th. It's our premier event, and it's being held virtually this year. It's going to leave you with knowledge, industry connections, peer sharing opportunities, all to facilitate business results. One of our keynote speakers, which I'm looking forward to, is Presidential historian Doris Kearns Goodwin, who will discuss leadership in turbulent times. So visit rmahq.org/RMAAC2020 to view the agenda and register today, or you can reach out to your relationship manager to discuss group rates for your team or your company. Today's webinar is the latest installment of our Credit Trends in Commercial Lending, a part of our risk analysis service, and it's presented, as always, by Tom Cronin and Jeremy Chalson from AFS. During the presentation, if you have a question for the speaker, click on the Q&A button and submit your questions there, and we will address as many of your questions as we can before the end of the presentation. And if we have some questions that we don't address, we'll be sure to get that back out to all of our attendees. Just a few housekeeping items before we start. You'll notice that we're using a different platform. And if you run into any technical difficulties with this new platform during today's event, please make use of the help widget, which is in the form of a yellow question mark at the bottom of your screen. Also, this platform is customizable, so you can feel free to move the widgets around on your console to suit your preference. So at this time, I'd like to turn it over to you, Tom, from AFS, and thanks everybody for joining us today.
Thanks, Stephen, and welcome to everybody today from a rainy Philadelphia. Now, here's what we're going to cover today. We'll start with a look at the C&I data and follow that with a review of the CRE stats. And then before we get to your questions, we'll do a quick summary of what we saw today. Now, the source of our information is the Risk Analysis Service, or RAS. And RMA and AFS have been collecting risks and performance data since the third quarter of 2003. We're now collecting this data on a monthly basis and have about 700,000 loans and over $1 trillion in exposure. So we'll first discuss the results for the C&I segment, and by way of definition, C&I loans are made for business purposes to public and private companies, generally with sales greater than $1 million. These loans are manually underwritten and risk-rated, and loans secured by owner-occupied real estate are included in C&I. So let's start with the trend in non-accruals and past dues, and we'll focus on the short-term delinquencies, which is the blue line, and then the non-accruals, which is the red line. So just a little over a year ago, loans that were 30 to 59 days past due, again with the blue line, were at 0.21%. By April of this year, the delinquencies had jumped to a service high of 1.33%. Now, since then, we've had a lot of volatility as the rate has moved up and down, and after 2 months of consecutive declines, we are now at 0.54%. We've had a similar pattern with the non-accruals, the red line, and that the non-accrual rate has been climbing since the end of 2018, but unlike the past dues, the non-accrual rate has not come back down. It's gone from 0.71 in March of this year to 0.99 here in September. And so on the next couple of slides, we'll take a deeper look at what's going on with the non-accruals. Let's start with the current situation. On this chart, we're showing the percent of loans on non-accrual for each two-digit NAICS code. We're going to drop down a couple of levels later on, but for now, let's just stay with the two-digit higher levels. It's easy to see that 21, mining, oil, and gas, is far and away the worst performing industry sector, with a non-accrual rate just above 8%. There are a number of other industry sectors that currently have non-accrual levels well in excess of the average. And those are, going left to right, ag, management of companies, 55 in the middle, admin and support, arts, entertainment and recreation, and accommodation and food services. And then sectors with very low non-accrual levels are retail trade, transportation, finance and insurance, and public administration. Next, we want to look at the change for each sector, September versus August. And what we are displaying is the absolute value of the non-accrual rate for September minus the non-accrual rate for August. So negative results mean that the sector improved as the rate dropped. A positive result in the red means the non-accrual level increased or deteriorated. And a number of industries showed a slight improvement, but I'd like to focus on the sectors on the left of the chart, which had the largest changes this month, all showing a deterioration. Admin, support, and waste management jumped from 1.7 to 2.5%. Accommodation and food services is up 0.42%, and the utility sector climbed 0.38%. And arts, entertainment, and recreation also saw an increase in their non-accrual rate of almost 0.4%. Let's go one step further with our analysis of industry sectors and non-accruals in a trend. We've looked at what's changed this month versus last, but I wanted to go back a little further and check where we were before COVID-19 and where we are today to see how industry sectors have been impacted by the various shutdowns due to the virus. First of all, I was shocked to see that for 13 of these 24 sectors, their non-accrual rate in September is lower than what it was at the end of 2019. Now, most of these are very small improvements, but we do see some big improvements for 22 utilities and another surprise, 45 retail. But while most of the improvements were minor, deteriorations were mainly substantial. Mining, oil, and gas has changed the most, almost tripling. We also saw huge increases in the non-accrual levels for management of companies, admin and support, arts, entertainment, and recreation, and 53 real estate. All of these at least doubled during this time period. And I'm sure you've heard or read that the virus had a dramatic impact on some businesses, but not on others. This chart would support that conclusion and the K-shaped recovery projection. Now, as promised, let's drop down a little and examine some industry subsectors. Pardon me. Recently, we've had an internal discussion about relevancy when looking at the high non-accrual levels. For example, if we saw a non-accrual rate of 12% for an industry subsector, but that subsector was very small, was it worth highlighting or even talking about? So with that in mind, on this chart, we're looking at the 10 largest industry subsectors and the recent trend in their respective non-accrual rates. And what we find is that only 2 of the 10 have had material deterioration, 531 real estate and 722 food and drinking. Only 2 have shown substantial improvements, those 2 being 611 educational and 524 non-durable wholesalers, and the other 6 are basically flat. And we'll talk a little bit more about this trend in a second. And one last look at performance at the subsector level. Here we've pulled the past dues and non-accrual statistics for 6 subsectors that at the outset of the virus were reported to be highly vulnerable to an economic shock. And all 6 are showing some decline in performance, either in delinquencies or non-accruals. If you look on the left-hand side, the delinquency levels have increased for 4 of the 6 subsectors, and all but oil and gas are now above the industry average. There's more of a mix with the non-accrual results on the right side. We haven't seen much movement for the brick and mortar, nursing homes, and accommodation from non-accruals, but oil and gas extraction, arts and food have all spiked and are well above the industry average of 0.99. And for arts, I did want to point out that what's weak in that sector are dinner theaters and fitness centers. We wanted to take one more look at performance and relevance. So let me take a second to explain what you're seeing here and how we calculate these percentages. They're a little bit different. So for percent total outstanding on the bottom, they're horizontal, we took the outstandings for each NAICS code divided by the total outstandings for all RAS. So you see F&I on the far right, it has about 12% of the total market. For non-accruals on the vertical axis, we did something a little different, a little twist we picked up from our friends at Zions Bank. Here we took the dollars of non-accrual for each NAICS code and divided that by the total dollar amount for all non-accruals. So if you look at oil and gas, non-accruals for that sector comprise almost a quarter of all C&I non-accruals in RAS. But oil and gas has less than 3% of the total outstandings, so it's representing a disproportionate share of the problem loans. Accommodation and food is another sector that has a smaller share of the outstandings, but a larger share of the problems. And I also tagged here 33 manufacturing and 44 retail, sort of in the middle, a little to the right. Now, both sectors have about the same share of outstandings, but they exhibit a very different picture when you look at performance, with a share of non-accruals for manufacturing almost 3 times that of the retail sector. And RAS banks can use the workstation to create this chart and compare the results to what we show here to identify those small share industries with larger problems and to perhaps de-risk. We started with this chart last month, and I thought it was worth continuing for a couple of reasons. So this is non-accruals by geographic region. And first off, you see the non-accrual level is up for every region except the West, and I'm looking at September versus March for being up. Secondly, for 5 of the regions, we're seeing significant increases in just the last month or two. And while the problems in the Southwest have been persistent since March, recently we're seeing severe uptakes in the Northeast and South and Western Midwest. So we have one last chart on performance. And so assuming that some of the non-accruals will result in charge-offs, I thought it'd be interesting to see what's the collateral behind the loans that might need to be liquidated. So loans secured by farmland and ag assets were close to 2% non-accrual rate, followed by loans secured by deposits and then residential real estate. And I thought here it was a positive sign that a very small amount of non-accruals are for unsecured loans. So now we're going to have our first poll question. Here we're asking about how you're risk rating COVID borrowers. So specifically, we want to know, has your bank created a special risk rating category for COVID-affected borrowers? And the answers are yes, and it's a pass rating. Yes, and it's a criticized rating. No, but we have moved COVID-infected borrowers to our lowest pass rating. No, we have moved COVID-affected borrowers to special mention or worse, or we are evaluating all borrowers individually. So we'll wait a few seconds here until we see some of the answers. Just wait another second or so. We're about there. Okay. So here are the results. So you can see not very many people have created special ratings for these. Again, not many have moved them. It seems everybody is basically evaluating the borrowers individually. So we'll move on and take a look at the risk ratings and the credit quality. So we move away from performance and onto credit quality as we look at our criticized trend chart. And just a reminder, in RAS, we take a bank's native obligor or borrower risk rating and map them to the RMA 10-point scale. And on that scale, 1 through 6 are pass, 7 through 10 are criticized, and further segmented as we're shown here, special mention, substandard, doubtful, and loss. Now, a year ago, the total percent criticized stood at 5.7% of outstandings. Now, percent criticized has climbed almost 300 basis points to 8.59%. And most, actually 76% of that increase, has been in special mention categories as banks re-rate loans that are impacted by the virus shutdowns. And just about every industry has had an increase, with large increases for the following, and these names should not be a surprise to anybody. Hotels, restaurants, airlines and cruise lines, fitness centers, dinner theaters, zoos, commercial equipment rental, lessors of non-residential buildings, and offices of physicians and dentists. So in addition to the percent criticized, we also wanted to see if there were any migration in the pass categories. So we create this chart which shows the risk rating mix for September 2020 in the red versus September 2019 in the blue. And it's very evident that as a whole, the C&I portfolio has shifted down in credit quality, or here shifted to the right. The percent of loans rated better than average and high pass all declined as we see jumps for the average and low pass. And so the average and high pass, better than average and high pass is 4, 3, 2, and 1. And then the average and low pass is 5 and on to the right. And the weighted average risk rating during this time period has jumped 47 basis points to 4.83. And it's led by 100% basis point increases for management of companies, mining, oil and gas, cruise and airlines, and hotels. And I feel like I'm continually repeating myself, but I believe all these performance and credit quality results just show how lopsided the virus impacts have been. Some businesses are doing okay, some businesses have been slammed, and for some, we don't know how they're going to do long term. And this is very different from what we saw in 2009 and 2010 recession. During that recessionary period, every industry was impacted. No sector escaped an increase in non-accruals or a declination in credit quality. But today's problems have been very limited to just a few industries so far. But one last quick look at the C&I data. Using the May 20 outstandings as a base, we've compared each following month to that base. And as you can see, outstandings, not counting PPP, have steadily declined. And from what we've heard from bank CEOs and CFOs on the third quarter earnings calls, this trend looks to continue for 2021. Now we'll take a look at the commercial real estate results. These loans, the loans in this portfolio are usually referred to as investor-owned properties, such as warehouses, apartments, office buildings, etc. And this chart displays the trend in non-accruals and past due for CRE loans for the past 10 years. You can easily see that up until 2020, the CRE performance numbers have been steadily improving, and in 2019, we hit service lows for short-term delinquencies and non-accruals. But 2020 has been a much different story with much more volatility, especially for delinquencies. So I'm going to switch to the next slide that looks at just 2020. Here you can see delinquency soared in April, dropped in May and June, were back up in July, but now have retreated again for 2 straight months. Well, however, the change in non-accruals has been a little less volatile, that's the red line, and started a little later this year versus the delinquencies. But non-accruals were up until June. Non-accruals up until June had been hovering in the 0.30% range. But we saw 3 successive increases in the percent of loans on non-accrual starting in June. In September, the percent leveled off a little bit, but now we're at 0.75 versus the 0.3 earlier this spring. Let's look at the major property types and see what's led to this overall increase in non-accruals. So what's up? Lodging quite a bit, the red line, followed by smaller increases in non-accruals for industrial and residential. Mixed use, multifamily, and office are flat, and surprisingly, retail has actually improved. And a quick note about the drop in lodging that you see for this month. Now, while it looks positive, we found that the drop was a result of a large loan sale. So that's not really an improvement. Similar to what we did with C&I, here we're showing the percent of criticized loans with details for special mention, substandard, doubtful, and loss. This chart mirrors very closely the performance chart. Continuous improvement through 2019 and into the spring of 2020, hitting a service low of 2.11% and criticized in March. But since then, criticized levels have soared, coming close to 9% in July and now sitting at 8.25% in September. From a property type standpoint, lodging is faring the worst, now over 50% criticized. We're also seeing elevated levels for office at 5% and multifamily just shy of 7%. We wanted to finish with a look at loan growth. Here we're looking at CRE outstandings with a base of May 2020, similar to what we did with C&I, and comparing the last 4 months to May. And there's not a lot of growth here, as you can see, but at least it is technically positive when compared to C&I. And one last look at CRE and growth. Here we're looking not at the change in balances, but loans that were actually originated in the month of September. And a third of the new loans were for residential properties. This seems to fit with what we've heard about the de-urbanization as a reaction to the virus in city life, especially for large cities like New York and San Francisco. And if you recall our August poll question, many banks had stopped lending to lodging, and we see here that only 6% of the new loans are from lodging. So to wrap it up, for C&I, September versus August, delinquencies have improved, non-accruals have deteriorated, credit quality has deteriorated, and loan growth has declined. For CRE, same as C&I, delinquencies have improved, non-accruals are really flat, credit quality improved a little bit, and loan growth is flat. So now I'll turn it back to Stephen.
Great, Tom. Thank you. It's amazing month over month we see kind of different patterns here, and it's I'm glad that we're now having these sessions monthly just because of that. So just a reminder, folks, this is your time to ask the experts. We have a couple questions queued up, but now would be the time to get yours into the mix too. So Tom and Jeremy, if you're ready, Robert asks a good question here. I think we've covered it maybe in a previous session, but to what extent would deferrals granted by banks be reflected or possibly not reflected in the delinquency rates?
So the deferrals are not reflected in these rates. The deferrals actually remove from our database. In essence, they remove that loan from our look at what's in non-accrual or past due. And we have tried to estimate what that would be. If we had a poll question a few months ago, and we figured that from that poll question, we determined about 10% of the loans have been deferred. About half of those have been deferred just because people asked for it. They really weren't in trouble. So you figure that's 5% of the people actually needed it. And from what we've seen since then, a lot of these deferrals are now have come back and starting to pay, but it appears that you have the possibility of anywhere from 100 to 250 basis points of loans that are currently in deferral that might go into non-accrual or into delinquency that could be added to those categories that we're seeing here.
Great. All right. Got a question here from Tony. And I think this is going back to the CNI section, maybe pages 10, 11, 12, Tom, but secured other on the collateral type. The question is, does this include loans underwritten with enterprise value?
Tony, if you could shoot me an email, we have our emails here. I'll take a look at that to see. I don't, off the top of my head, exactly remember if that is in secured other. I know assignments and things like that are in there, like assignments of oil rights and things. But if you shoot me an email, I'll find out about that for you.
Cool. Great. Thanks. All right. Next question is from Mike. Oh, hey, Mike. Glad you're back. When we get to the Q&A part, here's my question. With all of these credit quality headwinds, why have some of the larger banks announced loan loss reserve releases or smaller amounts, I guess? And incidentally, Tom, I have seen some of the very biggest banks come way down on loan loss reserves.
This is a good question. And I don't want to be cute or facetious, and my answer is I don't know what they're thinking. I don't know what they're looking at. The only thing I could possibly imagine is that the initial reserves were very high, and so they figure they have a little bit of wiggle room. But I just don't see how you can release these reserves now not knowing what's going to happen. And part of the reason I say that, we have another chart in here. Here we go. So this is the latest COVID new cases, and as of October 22nd. And I know it's higher than this. So given this and the lack of economic stimulus, I don't know why they're doing that.
Yeah.
And I have no explanation.
Yeah. My hypothesis, Tom, is that it was abundance of caution in the early days. And we've now had many months of kind of seeing how it actually plays out. And we're talking about, JP Morgan Chase, Citi, some of those top-notch analytical teams. Maybe they're able to provide more granularity on the weaknesses in their portfolios and can therefore substantiate that. So I don't know if that's super helpful for the rest of the folks, on the phone, but that would be my hypothesis. Okay, this next question is from Jan. Do you expect lots of consolidation in the oil and gas sector?
Well, I think the answer to that is yes. Because if you remember, oil and gas in 16, 17 had their issues and appeared to have recovered. I think the number that I mentioned was in the 3% range, and now they're way back up. And I can't see how it's going to end well for a lot of these companies that they might have survived 16, 17, but they're going to be short now.
Yeah, I think so too. Great. Okay, our next question comes from Tom. It would appear that government actions to support short-term CF and prevent foreclosures is supporting the CRE sector.
And I would agree with that. For now, so that's my caveat. I think short of a stimulus, this is going to change very soon, and you're going to see a lot of issues in the lodging and the office sectors.
Yeah, and some of those other retail that were on our list of kind of watch industries, I don't know how they're going to come back and be able to make their rent payments, and therefore how are their landlords going to make it? All right, our next question comes from Anne. Please, could you repeat your observation on the dentist and doctor offices?
I can if I can find it in my notes.
Okay, I was going to say about page 8 or 9, but you've got a different set of notes.
So that was in looking at the percent criticized. And so from September versus March, we've seen high increases in that area. That's one of the, along with hotels, restaurants, etc. We've seen a high level in the increase of percent criticized loans.
Our next question comes from Fred. If you took the oil and gas out of that Southwest geographical chart, the one that had the several months in a row, how would the charts look?
So we actually did that, and that was a question Stephen had asked us to do. So Stephen, I'm glad you had asked that.
Yeah.
And Southwest looks better, but it's not great. There are still some problems in there. I think if we remember correctly, about half the problems went away. So it's still some issues in there outside of oil and gas, but definitely a lot better.
All right, keep the questions coming, folks. This is great. This one from Joseph. Bank spreads have blown out, keeping rates around 4% for new, C&I, and CRE. Do you have any predictions on the rate trends rest of year and through the first half of next calendar year?
So I'll defer that one to Jeremy, because Jeremy works a lot with our pricing data.
Yeah, thank you, Tom. And I'm just trying to find the question here again so I can hear it one more time. What number is that on the Q&A?
Yeah, number 12 from Joseph.
Oh.
Yeah, it's really hard to kind of predict pricing over the next year or so. Looking at some of the pricing trends, this has been mainly a credit risk webcast, but we have seen actually spread widen year over year. One trend that's been taking shape in the markets is if you split the universe into investment grade versus non-investment grade loans, we are seeing pricing, I think both the underlying rates and the spreads increase in recent months. So kind of how Tom talked K-shaped recovery, where there's some industries that are doing, some that are doing poorly. If you kind of think of that same framework from a risk perspective, where you have good quality borrowers that are still, holding in this environment and the borrowers, I would say that pricing trends, spreads, and even rates might increase over the next few months for the riskier segment of the C&I universe.
That's great. Thank you, Jeremy. All right, another question from Robert. Thank you. Here it is. Back to the poll question. If we ask it a different way, I wonder how many banks are considering industry-wide risk rating adjustments. The best example would be hotels.
That's something we could take a look at going forward with a poll question next month or something. That's an interesting look.
I know it's been a hot topic among RMA members in various forums online and our Zoom forums and so forth. People are looking for good techniques and thinking about the adjustments that they want to make during this time, both with and without financial statements. Fred, following up on the loan loss reserves, how about managing earnings with a smiley face? Okay, yeah, that's always possible, right?
Yep.
I'll leave that to you guys that do that. Okay, question from Tom. Forecasts used by CECL banks have reflected improvement over the past 2 quarters. I guess that's a comment.
Yeah.
Okay. From Brooks, under CECL, we can tell the future. So we have all foreseen the increase the problem. Oh, you guys are pretty funny. I like this. Just kind of going through here. Susan, glad to see you on the call. Hope the audio is back for you. A question from Joseph. The path of the pandemic in America seems to be following the worst case scenarios as laid out out back in March, April. How should and how are the banks preparing for the next 6 months? And I can tell you that is also a question that's of high topic when we get our RMA members together with roundtables and other presentations.
Yeah, I mean, to be honest, not to plug the RMA conference, but I saw several of the sessions on the RMA conference basically right on this topic, and that's what I've been looking to attend.
It's okay to plug the conference.
I didn't mean to.
Yeah, and just add on that, because I think it was a consistent theme throughout the presentation when you look at different industries and how the deterioration and the impact of the pandemic hasn't been uniform, right? There have been some sectors that are still doing okay and some that are doing a lot worse. I think one step would be scrutinize your individual industry concentrations. So we know, for example, that consumer discretionary, retail, hotels, those areas where you really want a hard look at the individual credits and in long term think it might be able to diversify into what we might call more resilient industries. We do a lot of work at RMA and AFS looking at over the last recession or over a longer term horizon, which sectors have tended to be more resilient to these kind of black swan events. So really taking a hard look at your individual concentrations, trying to identify which of them are the riskiest, and then within the concentrations, really going at it at a loan by loan basis. I think that's a very broad framework for how you might try to lay out and prepare over the next 6 months. And as Tom said, I think there's some deeper analytics and insights up in the RMA conference.
Thank you, Jeremy. And we'll try to work on that sound quality. Jeremy, it's just a little choppy. Next one is from Kirby. Hey, Kirby, senior housing occupancy rates are dropping. Does the RAS data have granularity and insight into what is going on in that particular segment?
Kirby, we do have a split for senior housing, and I can pull some stats for that and send that out to you.
Terrific, thank you. Question from Roger. Could you define the difference between C&I versus CRE again?
Sure. So C&I are primarily what I call business purpose loans for manufacturing companies, retail wholesalers, things like that. CRE loans are primarily construction or long-term loans for investor-owned properties. So anything that would be, an office building, multifamily, things like that. That's really the difference between the two.
So like an owner-occupied for a C&I would fall into which one?
That would fall into C&I.
Yep. Okay.
Yep.
Hope that answers it for you, Roger. If not, give us ping us afterwards. Question from Dan, and I'm not sure if I 100% get this one. What have you been hearing as best practice pertaining to the content of the survey question? For example, risk rate per client, special class, et cetera.
So, Dan, that's part of the reason why we asked this question is to see just what people were doing. Because we had heard that there were a number of people that were creating COVID-impacted loans, a special risk rating category for them, and it was a pass category, and they're just leaving it there. But I think you can see from the poll question, what appears to be happening for most people is they're just looking at each individual loan and rating it that way.
Mm-hmm. Next question comes in from Brooks. Thanks for the question. Do you have observations about how the size of the company affects risk? Are smaller companies getting downgraded more than the big companies? Terrific question.
Yep. So Brooks, this is interesting because I've looked at this in the past, and historically, smaller loans perform worse and are risk rated worse than larger loans. What we've seen this time around is that smaller loans are sort of holding where they are. And we think a lot of that is because a lot of the PPP program went to the smaller companies. And so those are, in essence, they've been given 6 months freedom, for lack of a better word. And the problems that we're seeing, particularly with the oil and gas, are on the larger end in participations and credits above 25 million. So it's really switched. I think I did something on that maybe 2 or 3 webcasts ago. I'll pull it out and show it to you again. But it's switched from what it historically has been.
Yeah, interesting.
Yeah. And Steve, is my audio coming through now?
Yeah.
Okay, it's a little better.
Yeah.
Okay, I think my cord tangled up. Yeah, Brooks, we also, in a previous RMA AF webinar, we did migration analysis last month. And as Tom said, historically, most of the downgrades, if you go back even a couple of years ago, were in the smaller end deal size spectrum. And if you use deal size as a proxy for sale size, what we saw over the latest 1 year period is that the downgrade to upgrade ratio was almost uniform across the deal size spectrum. So it wasn't just confined to smaller end loans or the smaller borrowers. It was pretty broad-based across the size spectrum. And as I said, there's a number of explanations for that. One of which is, oil and gas tends to be larger, so we're seeing that kind of play into the bigger deals. But it's been remarkable just how uniform and spread out the downgrades have been when you distribute it by size.
Terrific. Yeah, thanks for that. Okay. Oh, good. Matthew asks this. Similar question or suggestion regarding that poll question. I feel it's important to distinguish between the COVID impacted versus deferred loans. We have heard that some banks are using a generic risk rating for all deferred loans as the lowest pass, but not for COVID impacted, since that is extremely subjective. Guys, any comments on that?
Now, again, we can take, so there have been a couple suggestions here on what to do with the poll question. We'll take a look at these and maybe come back next month with another poll question to kind of define or refine a little bit what we'd asked. And I thank Matthew for that suggestion.
Yep, that's good. That's good. Well, great. Just a quick reminder, if you've got that burning question, now is the time. I think we've gone through maybe almost 20 questions so far, so thank you for that so far. And we've run to the end of it. Before I do the closing, Tom and Jeremy, is there any other wrap-up or any other item?
No, I just appreciate everybody joining today. And thank you for your attendance and continued attendance at these webinars. We're really excited with the level of participation.
Yep, we do have one more question, but I do want to echo that. I know that you guys have a lot of things on your plate, especially this season of the year. And so you making time to attend it is very important, and we appreciate that. This maybe last question came in from Amy. Is there a way to get the slides in a different format so we can read the data better and forward to others? We will work on that. I did get a little bit of feedback. I think it was from the last session that it was hard to read some of the detail. So I get it, Amy, and we'll try to do a better job of that. Okie doke. Well, I think that wraps it up for today. Please consider joining us for next month's session, which is on the website already towards the end of the month. I want to say a special thank you to both Tom and Jeremy, as always, for all of your insights and all the work that goes into to putting these together. And thank you to everybody else for joining us on the call. We look forward to having you at our next session on this topic. Be sure to register on our website. We also have an upcoming webinar called Demystifying the Frontline's Role in Operational Risk Management, which is coming up after the annual conference. So that's on November 17th. I'm looking forward to that, and I encourage you to look into it as well. So that concludes our webinar for today. Please take a moment at the conclusion of the event to complete our post-webinar survey. We read everything, we look at the results, and we try to make these better based on your feedback. So appreciate for that. And thank you, Tom, Jeremy, and everybody. Have a great day.
Thank you.
Thank you so much.